The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast. How's it going, everybody? Welcome back to Trajecta Talks. I'm your host, Alex Savanovic. And for those of you who are new, I'm an experienced hedge fund trader, and this podcast is all about demystifying the world of finance for you, the next generation of leaders, innovators, and investors. I'm so glad you're here, whether you're listening in your dorm room, maybe you're on your way to class, or maybe you're just trying to figure out what's next after high school. My goal is to equip you with the knowledge and confidence to build a solid financial foundation and make smarter money decisions. So, a few weeks ago, we did a level 2 episode on this topic. We went deep into the mechanics of stocks, bonds, and options, dissecting everything from growth versus value, investing to the math behind bond yields. Today, we're taking it to the next level. We'll definitely do another part because there's so much to cover, but this is where we start to get to the masterclass level of things. We're going to peel back another layer of complexity and talk about some of the most sophisticated financial products out there. We're going to dive deep into the world of credit default swaps or CDSs. We're going to unravel the differences between forwards and futures. And for the first time on this podcast, we're going to demystify the Black-Scholes model and the basics of option pricing. We're also going to take a deep breath and jump into the massive, globally interconnected world of the foreign exchange market and its derivatives. This is a super dense episode, but I promise we'll break down each concept with clear analogies and examples. I know when I was learning about all of this at work and in school, it definitely took me a couple times to really understand the concepts. So let's get right into it. Grab your notebooks, get your headphones on, and let's get smart about some serious financial topics. Let's start with a foundational concept in the world of derivatives, forwards and futures. So at their core, these are both agreements to buy or sell an asset at a predetermined price on a future date. So the key difference between them, however, is crucial and defines their use. A forward contract is a private, customizable agreement between two parties. It's an over-the-counter, or for short OTC, transaction, meaning it's not traded on an official exchange. So let's use a simple example to illustrate the concept. So let's imagine a farmer who grows wheat and a baker who buys it to bake all of his cakes and bread. The farmer is worried that the price of wheat might fall by harvest time, which would hurt his profits. And the baker, on the other hand, is concerned that the price of wheat might rise, which would increase his costs because wheat is an input cost to bread and cake and various other products that you bake. I'm not a baker, but you get the point. So, to manage this risk, they enter into a forward contract. So let's say our baker and our farmer, they agree today that in 6 months, when the wheat is ready for harvest, the farmer will sell the baker 100 bushels of wheat for $7 a bushel. So this price is locked in regardless of what the market price is in 6 months. So we have our example of the 100 bushels at $7. Let's go through a scenario one. Well, let's say wheat prices rise to $8 a bushel. So the baker wins. He can buy the wheat for the agreed upon price of $7, saving $1 per bushel compared to the current market price. The farmer, however, loses out on the extra dollar that he could have made had he not entered the forward agreement. So the flip side is also true. So scenario number two would be the wheat prices fall to $6 a bushel. The farmer wins. He's guaranteed to sell his wheat for $7 a bushel, which is a dollar more than the current market price. The baker, however, must pay the higher agreed upon price. The beauty of a forward contract is that both parties have removed the uncertainty of price fluctuation. They have hedged their risk, so to speak. So, but because it's a private agreement, there are some risks. So, what if the baker goes bankrupt and can't pay for the wheat? Or what if the farmer's crop fails and he can't actually deliver the wheat to our baker? This is counterparty risk, and it's a major characteristic of forward contracts. So, moving along, let's talk about futures. A futures contract is the standardized exchange traded version of a forward contract. So the underlying asset, like wheat or oil or gold, the quantity, the quality, and the delivery date are all standardized by a central exchange like the Chicago Mercantile Exchange. And you'll sometimes see that abbreviated as CME. So to keep things easy, let's continue with our example now with the futures contracts. Instead of a private agreement, the farmer and baker can use a futures contract. The farmer sells a futures contract for wheat, and the baker buys one. But here's the critical difference: they don't have to worry about the other party. The exchange itself guarantees the transaction. So, how does the exchange like the CME do this? Through a system of margin requirements and daily settlement rules. So, both parties must deposit an initial amount of money known as initial margin with the exchange. Every day, as the price of the underlying asset fluctuates, the positions are marked to market. If the price of the contract moves against you, money is automatically taken from your margin account and transferred to the person on the other side of the trade. This process of daily settlement ensures that there's always enough collateral to cover any potential losses, which virtually eliminates the counterparty risk that exists with forward contracts. So, forwards are customized and private, futures are standardized and traded on a public exchange. Forwards are often used by corporations to hedge specific non standard risks, while futures are used by a much broader audience for both hedging and speculation. A speculator might buy a futures contract on oil not because they want to take delivery of that actual physical oil, but because they believe the price will rise, allowing them to sell the contract for a profit. So that's the basics on forwards and futures. Let's move on to part two, which is credit default swaps or CDSs. Now, we're going to discuss this product that was at the very heart of the 2008 financial crisis. Like I said, the credit default swap or CDS. So essentially, a CDS is an insurance policy on a bond or other debt obligation. It allows a party to swap or transfer the credit risk of a debt instrument to another party. So let's imagine an example. A bank, we'll call them Bank A, and owns $100 million worth of bond issued by a company, Company Z. Now, Bank A is worried that Company Z might default and not be able to repay the loan. So, to protect against this, Bank A can enter a credit default swap contract with another party, and we'll call them the insurance co. So, our parties, just to recap, we have Bank A, which is the protection or insurance buyer. They pay a periodic premium, sort of like a monthly insurance payment, to the insurance co. Insurance co is the protection seller or the insurance seller. They receive the periodic payments. Now, in return, they agree to pay Bank A the face value of the bond if Company Z, who issued the bonds, defaults. Now, let's talk about the event occurring. Let's say Company Z does not default. Bank A simply continues to pay its premiums to the insurance company and receives its interest and principal payments from Company Z like nothing else happened. Insurance Co. keeps the premiums and makes a profit. And if Company Z does default, the credit default swap is automatically triggered. All of a sudden, Insurance Co. must now pay Bank A the full $100 million face value of the bond in exchange for the defaulted bond. Bank A has successfully hedged its risk, and Insurance Co. has taken a huge loss. So, this was a super simplified example. It's never that simple in real life, but I just wanted to illustrate the concept, and it shows how a CDS can be used as a form of hedging. Financial institutions use them to protect their portfolios against the risk of a major corporation or even a country defaulting. Now, credit default swaps are not just for hedging. They are also excuse me, they're also heavily used for speculation. Someone could buy a credit default swap on a company's bond, even if they don't own that bond, simply because they believe the company is likely to default. If it defaults, they make a massive profit, and if it doesn't, they lose the premiums that they paid. This speculative use is one of the reasons why the credit default swap market exploded in the years leading up to 2008 when the great financial crisis occurred. So let's talk a little bit about that because I think it's important to understand as it relates to CDSs and the historical context. The problem in 2008 was that too many of these swaps were written without adequate capital to back them up. So the global financial system became so interconnected that when a wave of mortgage defaults began, it triggered a domino effect, leading to the collapse of institutions that had sold a massive amount of insurance they couldn't possibly ever pay out. So that's enough on CDSs. Let's move on to options, which I'm excited for because we're going to talk about option pricing and the Black-Scholes model. So, in our last episode, we talked about how options give you the right, but not the obligation to buy or sell an asset. We talked about how they're used for hedging and speculation. We also introduced the concept of intrinsic value, how much the option is worth if you exercise it today, and time value, which is the extra premium you pay for the chance that the option will become more valuable over time. But what we didn't dive into, because that was, you know, lighter episode is how is that premium, the time value, actually calculated? How do you get a precise theoretical price for an option? And the answer is the Black-Scholes model. So the model, developed in 1973 by Fisher Black and Myron Scholes and Robert Merton, revolutionized financial markets and earned its creators a Nobel Prize in economics. So on the surface, before I say anything, the formula looks very complex. It definitely terrified me when I first came across it, but its power lies in the inputs. The model takes a handful of observable variables and calculates a theoretical price for an option. So let's break down the inputs. The price of the underlying asset, that's usually denominated by the letter S. This is the current market price of the stock, for example. So if you're looking at an option on Apple, this is Apple's current stock price. All else being equal, a higher stock price means a call option is more valuable and a put option is less valuable. So the next significant input to the formula is the strike price, often denominated as K in the formula. This is the predetermined price at which you can buy or sell the underlying asset. We've talked about that in the past. The closer the strike price is to the current stock price, the more expensive the option will be. Now, the next input is time to expiration. That's denominated by with a T, capital T. This is the time remaining until the option expires. This is a very important input. So the more time that an option has, the more time it has to move in the money. So, and become profitable. Therefore, options with a longer time to expiration are always more valuable than those with a shorter time to expiration, all else being equal. The time value of an option erodes as it approaches expiration, which is it's a phenomenon known as theta decay. The risk-free interest rate, denominated with a lowercase r, is another part of the formula. This is the theoretical rate of return of an investment with zero risk, often represented by the interest rate on a short-term U.S. government bond. The risk-free rate is a factor because money has a time value. A higher risk-free rate increases the value of a call option because the holder of the call can delay buying the stock, and the cash they would have used to buy the stock can be invested at the higher rate. The next input to our formula is volatility. This is arguably the most important and the one that is not directly observable. It is a measure of how much the price of the underlying asset is expected to fluctuate over a given period. So the more volatile a stock is, the greater the chance that its price will move dramatically, which makes options more valuable. So think of it this way: a highly volatile stock has a much higher chance of hitting an extreme price, making both call and put options on it more likely to be profitable. Volatility is often expressed as an annualized standard deviation. So the Black-Scholes model is a cornerstone of modern financial theory. While it's not perfect, it makes some assumptions that aren't always true in the real world, such as constant volatility, which is not true. It provides a powerful framework for understanding the variables that drive an option's price. So when you see an option price on a trading screen, it's the result of countless calculations using models like this one. So moving on from options, we'll definitely touch base on that a little more later. I do have a surprise for you at the end of the episode. Let's move on to foreign exchange for now. So, the foreign exchange market, or Forex market for short, is the largest and most liquid financial market in the entire world. It's where currencies are traded. So, unlike a stock exchange or even a bond market, Forex is a truly global, decentralized market that operates 24 hours a day, 5 days a week. So, the fundamental concept of the Forex market is something called a currency pair. When you trade in this market, you are always trading one currency against another. So the price of a currency is always expressed in terms of another currency. So, for example, the most traded currency pair is the euro versus the US dollar. The euro is the base currency and the US dollar is the quote currency. The price you see, for example, one spot 20 means that 1 euro is equal to $1.20 US dollars. If you believe that the euro will strengthen against the US dollar, you would buy the euro slash USD pair. If the price goes up to one spot 25, you could sell it for a profit. And if you believe the euro will weaken, you would sell the euro dash USD pair. So the Forex market is so massive because it serves two primary functions. Number one is commerce. International trade relies on this market. A company in the US that buys goods from a company in Germany needs to convert US dollars to euros to pay for them. Next up is speculation. That's another big reason. Trillions of dollars are traded every day by speculators who are trying to profit from tiny fluctuations in currency prices. So, just like in other markets, there are a variety of derivative products that allow participants to hedge or speculate in the Forex market. It really, in that sense, is no different from the stock, bond, or any of these other markets that we've spoken about. So there are forwards, like we've talked about in this episode. These are the private customized agreements between two parties to exchange currencies at a fixed rate on a future date. A US company that knows it will have to pay a German supplier 1 million euros in 6 months might enter into a forward contract to lock in the exchange rate today, protecting them from any rise in the euro's value. There are also Forex futures. These are standardized contracts to buy or sell a specific amount of one currency against another at a future date. They are traded on an exchange, so they eliminate counterparty risk and are used heavily for speculation. There are also Forex swaps. Forex swap is an agreement between two parties to exchange one currency for another at one point in time and then to swap it back at a later time. They are most commonly used by multinational corporations to manage cash flows and hedge their foreign currency exposure. Now, this is all I have to personally say on the topic. But last week, I did promise there would be a surprise on today's episode. And that little surprise is that Ethan is joining us today to give us some insight and wisdom to some of the products that we've spoken about here today. For those of you that don't remember, on I think it was episode 4, it was a very early episode, Ethan from Spoonbill Partners taught me everything that I know in this business. We're very, very lucky to have him on today. So, everybody, like I said on the episode, we have special guest Ethan White's here to talk about some of the things that we spoke about on the episode this week. So, Ethan, how are you doing, buddy?
I'm great. How you doing?
Oh, I'm perfect. So, just to get you up to speed, we
Yeah,
covered on the episode today credit default swaps. We talked a little bit about options and a little bit how they're priced and Black-Scholes model stuff. We spoke a little bit on forwards and futures, just a little bit more advanced financial instruments and
great.
derivatives. So, yeah, I know you and I spoke off air a little bit about you wanting to come on and discuss a little bit about options and hedging. I think it would be great
Sure,
for the viewers. So, yeah, feel free
sure.
to take it away.
Yeah, I'll just bring up sort of the areas where I don't think they're under the definition of options. The two areas where I've made mistakes, so investing, trading in options, and I guess let's just to keep the episode short for you, we'll just do one section, which would be the covered call stuff for me. Um, so the covered calls typically is a strategy where you're, like you obviously explain, you're long security and you that has options on it. And let's just say it's, dated, today's security you're long and you want to sell a option in October. Let's pick Google, for instance. I'll give you an example of, as I said, a couple of things where I've made mistakes that I think would help people. Um, the first would be that example, which is, so let's just say, I guess let's back up and let's not use today let's use Google 2 weeks ago. So you were thinking, well, hey, listen, this Gemini for free is looks so much better than ChatGPT, and they've really caught up to that, sort of ChatGPT 4.0 standard. I can actually cancel my subscription. I can just do Chat. Google's defended their AI turf really well. I'm going to buy some Google, which would be, let's just say, middle of August, and you say the stock's at 195, and you're going to, I really want this part of my portfolio. I'm going to sell the 205 calls for, let's just say, when I say maybe the September 205 calls for $3. So I buy at 195, I sell the 205s for three. I have $13 of potential upside, and I have $3 of protection from my cost basis. Here's mistake one that I've learned. In a portfolio of either 10 names or 100 names or even 500, there's only a couple of outsized large winners. And it might not be many, but you need them in the portfolio to have no upside cap on them for this reason. So you thought, this is great. I'd be so happy with making $13 in Google between now and, I don't know, the next, let's say, 4 or 6 weeks. And then there's an announcement overnight where a judge rules in favor of Google. It opens up $20. You've made the same $13, but that might have been the winner in your portfolio of 10 names or 100 that would have paid for many losers and helped with outperformance in the belly of the portfolio as well. So the capping the upside, I think, is critical. Now you're all of a sudden looking at Google and you're like, my gosh, basically I sold it at 205 plus 3 at 208. It's trading high 220s, depending on which Google you bought, which class, and it could go to 250. And you've essentially taken that name out of your portfolio. So that's, I think, number one. And then number two is, from a trading standpoint, where I also run into a problem is when things don't go my direction. Let's just use UNH as an example. This is real life example. I started buying UNH in the low 300s and was selling some 300 and 310 calls along the way. I said I wanted to be there for the next 6 to 12 months. And then over the period of time I was doing that, the stock, I don't think, went up for 6 or 7 days in a row after I bought it. And not only did it not go up, but there were signals to me that I should have been out of the trade from a trading standpoint. It was underperforming the healthcare group. It was clearly underperforming the market. It was responding poorly to even good news. There was nothing about the price action that should have kept me there. The problem was I was in a covered call position. Let's just say they were January 300s, 310s. I had a couple of different positions. And I kept saying to myself, well, I'll just wait until January, and I'll get my $5 in premium, $6 in premium. But I ignored stop losses. So I watched the stock go down 10%, 15% from my costs just because I had a little protection with a January buy right, opposed to cover the buy right, cover the January call, and get out of the stock. So you tend to get, one tends to freeze up, or at least I do, in a situation like that when it starts to go against you, and you kind of anticipate it'll be fine in a couple months, and I'll use that premium, and then I'll re-roll it again in March, April, and that's just very costly. So that was, I guess, those are the two things that you and I discussed, which it's not kind of in the definition of a call, but I can tell you real life the mistakes there that have cost me. So
Awesome. No, that's perfect. E. Thank you for sharing that. And we did also on the episode talk a little bit about how actual options are priced. Could you speak a little bit, just because I know you're the pro and you've done this for a
No,
long time, especially as it relates to options. Can you
no.
give us a little bit a
Oh
little
my
bit
gosh.
about the
Yeah.
pricing and just I know the extrinsic and intrinsic value of things is a little bit difficult for some people to wrap their heads around. I gave my
Yeah.
explanation, so maybe if you could give yours and try and dumb it down a little further for
Yeah. I
people
mean,
who want to understand.
no, the Black-Scholes model, I don't know how, in my mind, I could not define it, but I could tell you what it's come down for me, which is, I know not what you want to hear, but it's just feel. And I'll tell you why. And I would recommend, rather than, and I'll give you an answer to that, but I would recommend what people do is look at the stock they own and then just go through an option chain and go to, let's say, the next month out, let's go to 3 months out, let's go to 6 months out, and start to learn where your options in your stock trade. And then look at the S&P 500 ones, then look at something like I guess NVIDIA is starting to become closer linked and has a higher correlation to the S&P 500, but then start looking at some of these AI names, these small mid-cap ones, and look at the options there, and you'll realize how much more premium. So the premium, it would be based on time and volatility, just to keep it simple. So a utility name, um, which has a 6-7% yield, has little to no put or call premium, um, because there's little growth, and most of the growth is basically paid out in dividend. Obviously, utility bills are relatively constant in most states, so you don't get the premium there. The only You'll have the intrinsic value, as you said, which is what it's worth if you exercised it that same day. And the volatility, as I said, you won't get much. And then let's just say if you looked at Duke Energy, and I'm just sort of guessing now, but you look at the December calls versus the March calls of next year. Obviously, December calls are going to be cheaper and have less time premium than if you go out an additional 90 days. Um, and for me, the reason I think I can sort of get a feel for where it's trading is just, like I said, just looking at so many of them, trading so
Mhm.
many. I don't have and I think people would, like, to your point, almost it'd be a waste of their time to go to, let me look at the definition of Black-Scholes, because the option market prices, and you're able to sort of get that data real quick just by pulling up option chains.
Of course, of course. The only other thing I wanted to bring up now, it's coming back to me, when we were talking about the covered calls. Can you help illustrate, I guess, the dangers of not owning the underlying and employing that strategy?
So you're saying not owning and just doing a short call
Yeah,
with,
yeah, like
yeah, yeah,
naked, exactly.
yeah. So a naked put is, believe it or not, not believe it or not, it's a lot less risky than a naked call. The idea is you could get a naked put in the stock, and worst case it goes to zero. That's worst case. Um, and so you sell a put. Let's just go through an example. Let's use the UNH example. I sell a put. Let's say I'm long at 300. I sell the 270 put. That would be not a hedge, but that would be an outright sort of a risk take. I wouldn't do that. I would be, without being long the stock, I'd say, hey, listen, I am looking at UNH at 300. At 270, I'm interested in buying it. So let me sell the 270 put naked and get a few dollars of premium. Let's say I get $5 a premium. So I would essentially say to myself, I'm okay owning UNH at 270 minus the $5. So I own UNH at 265. The risk there is exactly what happened to me, which is you sell the put. I did not do this, but this is the scenario that would have occurred, and you end up owning all this UNH at 270 minus the $5, and the stock's at 235 after that bear downgrade on the low, and and you start to realize, why did I do this, without the ability to sort of cut a loss.
Right.
And the whole time the put you're short is going up in value, but you're saying it's okay. I'm going to end up owning UNH long term. It's a wonderful company. that's the risk of selling a put, which is obviously not nearly as bad as selling a call. Here's the risk in selling a call: stocks can go to unlimited upside, could in theory go to infinity. Not that we have seen that, but in a GME example, if you're short a call, meaning let's say GME is let's the end of 2020 or early 2021. I don't remember when that happened, but as sort of a frenzy kind of crazy had happened in Tesla as well. But let's just say GME is trading 35, 40, something around there. And you're like, oh my gosh, there's no way it's going to go to 50. I'm going to sell the 50 call naked for, and it's going to be, it's September. I'm going to sell an October 50 call for $5. This is crazy. I could sell someone the opportunity to buy that stock $10, $15 higher. I get $5. This is great. You say to yourself, it's a free money, $5, and GME has what happened, and next thing you know, the stock goes through 50. You're shorted your options. You're shorted 5 are now 10, 15, 20. The stock goes to 100. You have options that are now that you're short from a $5 cost, where your best case was you're going to make $5 in a trade. You have options that could be trading at $50, $60. And then you have a margin call potentially, because you have to, in theory, if you're a margin clerk, you then have to think, well, he's in essence synthetically short a stock at 50. Now he has to raise the funds to be synthetically short that stock, with the options trading, at, let's say, 50 and the stock at 100. It's a much different transaction than when you went into it. So could be forced to cover at the peak. So all things that I've done, and all so yes, if you ever need a phone a friend, I'm always happy to give you a scenario that I've sort of choked on, and hopefully learned some from. That's for sure.
Oh no, that's awesome. No, we very much appreciate you coming onto the show and giving us a couple of your explanations and
Yeah.
good stories. And we always, I don't have many real life examples, but I know you have a lifetime of them. So it's always good
Yes.
to have you and give the stories. So, uh,
Lifetime of
yeah,
mistakes, buddy. Yeah.
don't say that. E, thank you so much for coming on. We really appreciate it. And hopefully we can have you on again soon. Unless you have anything else you want to add, I
That's
think
it,
we're
buddy.
good.
Have a great day. I'll let you guys go.
Thank you, E. You take care.
Take care. Bye.
Bye-bye. Well, there you have it, folks. That's the episode. You got some unique insight from Ethan White. This is truly just the surface of these topics. The world of derivatives is incredibly complex, fascinating, but understanding the core mechanics is a critical step in becoming financially literate. Credit default swaps are essentially insurance. Futures and forwards are all about locking in a future price. And the Black-Scholes model shows how option prices are a function of just a few key variables. The Forex market is the fundamental engine that powers global trade, and its derivatives allow for the management of currency risk. That is all the time that we have for today. Thank you so much for joining me on Trajecta Talks. I hope that this masterclass on securities and derivatives discussion has given you a clearer, more nuanced understanding of these vital financial products. Remember, the journey to financial freedom begins with a single step, and that step is knowledge. To stay connected and continue your learning journey, be sure to follow us and our sponsor, Trajecta University. You can find us on Instagram, LinkedIn, and Facebook by searching for Trajecta University. Also, check out our YouTube channel at Trajecta Talks, where you can watch this episode and find a ton of other great content. All the links are in the show notes for you. Join me next time as we continue our conversation about building your financial future. Until then, keep learning, keep investing in yourself, and keep building your future. Have a very happy Friday. Take care, folks. I'll catch you on the next one.